Welcome to the Consumer Financial Protection Bureau's field hearing in Los Angeles, California at the Japanese American National Museum. At today's field hearing, you will hear from Director Richard Cordray and a panel of distinguished experts who will discuss issues related to small business lending. Today, the Bureau issued a request for information to learn more about ways to gather and use new and existing information to identify the financing needs of small businesses, especially those owned by women and minorities. With this RFI, the Bureau aims to enhance its understanding of the small business lending industry. The Consumer Financial Protection Bureau, or the Consumer Bureau, or the CFPB, is an independent federal agency whose mission is to help consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. My name is Ixta Martinez. I'm the Associate Director for the External Affairs Division at the Consumer Bureau. Our audience today includes consumer advocates, industry representatives, state and local officials, and of course, consumers. We're delighted that you are here, and we are delighted to be in the city of Los Angeles. We are grateful to have with us today the Honorable Mike Feuer, City Attorney for the City of Los Angeles, the Honorable Jan Lynn Owen, Commissioner of California's Department of Business Oversight, and the Honorable Xavier Becerra, California's Attorney General. We're also grateful to be joined by representatives of the Small Business Administration and the Federal Reserve. So let me just spend a few minutes telling you about what you can expect at today's field hearing. First, you'll hear from City Attorney Mike Feuer, then Commissioner Jan Lynn Owen, and then Attorney General Xavier Becerra. Following their remarks, you'll hear from the Consumer Bureau's Director, Richard Cordray, who will provide remarks about small business lending and the RFI. Following the Director's remarks, David Silverman, the Acting Deputy Director and the Associate Director for the Bureau's Research, Markets, and Regulations Division, will frame a discussion with a panel of experts. After the discussion, there will be an opportunity to hear from members of the public. Today's field hearing is being live streamed at consumerfinance.gov, and you can follow CFPB on Facebook and Twitter. So let's get started. Los Angeles City Attorney Mike Feuer has long been one of California's leading lawyers and lawmakers. As LA's chief lawyer and prosecutor since July 2013, he has brought an innovative, problem-solving focus to the office that combines tough and effective prosecution with creative initiatives to improve public safety and the quality of life throughout the city. His efforts have also sparked change throughout the state and the nation. Under the city attorney's broad authority, Mr. Feuer frequently has sued to protect consumers. For example, in September, he announced an historic settlement of a lawsuit against Wells Fargo for opening unauthorized customer accounts. He and the CFPB joined forces in complementary actions requiring Wells Fargo to pay restitution to its customers, put protections in place to stop illegal behavior, and pay $105 million in penalties. Previously, Mr. Feuer served as the majority policy leader of the California Assembly and chair of the Assembly's Judiciary Committee, where he jointly authored the Homeowners Bill of Rights. Mr. Feuer, you have the floor.
Thanks very much. That's one of those cases where the introduction was longer than my remarks, but that's pretty good. Very, very generous. Thank you so much for doing that. I want to, on behalf of all of us in the city of Los Angeles, welcome in particular our director, Rich Cordray, to our city. And just a word about that collaboration that was just mentioned. You know, I was extremely proud of the work of our office, some of whose lawyers are here with us today. in pursuing the Wells Fargo litigation regarding the fake accounts. And obviously that's had a catalytic effect, not only with regard to Wells practices, but other banking practices across the country. I want to underscore there is no way that that litigation could have had the profound impact it has had without the deep collaboration with the Consumer Financial Protection Bureau under Mr. Cordray's leadership. We also worked as well with the Office of the Comptroller of the Currency nationally, but this collaboration was essential. And in that regard, I must say today that while we're here in Washington, there are efforts underway to either diminish the authority of the CFPB or eradicate it altogether. I had the opportunity to be in Washington last week for multiple purposes, including discussing how we should all work together to assure the continued viability and strength of the CFPB. Mr. Cordray's leadership has been remarkable. That organization has been instrumental in protecting consumers across the nation. And I would just say today that anybody who cares about consumer protection should be standing up and loudly denouncing efforts to undermine the CFPB. I did a radio interview this morning. I got applied applause from two government officials, but all right. Okay, good. Yes. Because that applause was for Rich and his team, not for me, which is where it should be. I was interviewed this morning on the radio here, and I was asked, the purpose of which was not actually about this, but then the commentator shifted to what was happening here today and said to me, well, do you think, in light of what's happening in Washington, the attacks on the CFPB, is the Trump administration too business friendly? And given that this is a focus on small business, I want to really focus on that point for a second. We should all be business friendly. That is a key role for government to play. But being business friendly does not mean protecting businesses who violate the rules at the expense of consumers. Being business friendly does not mean protecting businesses who violate the rules who are in competition with those who play by the rules. That's what being business friendly means. It means supporting businesses who are playing by the rules to do even better, which is why I'm particularly pleased to be here today as we focus on access to capital and other issues that challenge small businesses, especially small businesses that are located or do business in disadvantaged areas of our nation. With us today is my special assistant, Capri Maddox. Capri is where? Where did Capri go? Capri is here. So Capri is in charge of my office's outreach to the business community. We are working to connect businesses that are trying to improve and expand and hire more people, especially in disadvantaged areas, to capital, to training on how they can do better, working with other nonprofits to do the same thing. I'm eager to hear today what more we need to know, and therefore what more we need to do to assure that small businesses can succeed, especially in neighborhoods of our city and our nation, where we should be compelled to do better. Because everybody who wants a job should have access to a job, and our small businesses are the way that we're going to assure that in America, we are a nation where the dignity of work is elevated to the place where it needs to be. So, Mr. Cordray, Rich, thank you very much for your leadership, for the collaboration. You're going to be hearing from two other partners with whom I am extremely proud to be sharing this room today, Jan Owen and Xavier Becerra. But for today, I'm eager to learn more so we can do better. Thanks very much.
Thank you for the remarks. They're greatly appreciated. Our next speaker is Janlyn Owen. Janlyn Owen was appointed to be the first commissioner of the Department of Business Oversight by Governor Edmund G. Brown in July of 2013. Previously, Ms. Owen served as commissioner of the California Department of Corporations, appointed by the governor in December of 2011. Prior to that, Ms. Owen was the principal at the Jan Owen Group since 2010. She was also a strategic initiatives manager at Apple Inc. from 2009 to 2010, vice president of government affairs at JP Morgan Chase from 2008 to 2009, state director of government industry affairs at Washington Mutual from 2002 to 2008, and executive director of the California Mortgage Bankers Association from 2000 to 2002. Ms. Owen also has extensive experience in public service. She was acting commissioner of the Department of Financial Institutions from 1999 to 2000, after serving as deputy commissioner from 1996 to 1999. Ms. Owen also served as executive director of the Department of Insurance's California Organized Investment Network program after serving several years as consultant to the Senate State Banking Committee. Commissioner Owen, you have the floor.
So every time I hear that introduction, I think, oh, holy moly, I'm really old. I'm going to spend a few minutes today to thank my partners, City Attorney Feuer, Attorney General Xavier Becerra, which we're so glad he's there, and my partner in crime, Director Cordray. But I'm also wanting to give you some data. So we've done some data collecting for California. As the cranky old bank regulator in the corner, we get some information that I think is important for you to be able to look at as we discuss this issue. The Department of Business Oversight oversees over 360,000 licensees from banks, credit unions, mortgage lenders, payday lenders, securities broker dealers and investment advisors, money transmitters, and also, we supervise franchisees, and we approved proposed state securities permits. Our job is daunting, exciting, and rewarding. And with my partners, it is truly a challenge I wake up and want to do every morning. In 2015, California's GDP surpassed $2.5 trillion. Hence, we are the 6th largest economy in the world. That same year, our non-bank licensees reported to us that they originated $412 billion in loans in California. That's more than the total of 35 states' GDP. These non-bank lenders make more than 78% of their loans to commercial enterprises, most of which are small businesses. California is home to more than 3.8 million small businesses. These firms employ 50% of California's workforce and drive our economy. Our small businesses are respected globally for their innovation and, frankly, their fortitude. The vast majority employ 500 or fewer workers and collectively make up 99% of all the businesses in California. 2 years ago, the U.S. Small Business Administration reported California leads, God, that's annoying, isn't it? The country in several different categories. Number of small business employees, 6.5 million. Number of self-employed individuals, 2.5 million. Number of self-employed minorities, 1.1 million. And the number of self-employed women, 973,000. According to the U.S. Census Bureau, California leads the nation with 1.6 million minority-owned businesses. LA County leads the nation with 55% of local businesses minority-owned, more than half of those by Latinos. California is also proud to be the nation's greatest number of women-owned businesses, nearly 1.5 million. Women-owned firms employ more than 1 million people and generate more than $222 billion in annual revenue. Now, the number of women-owned firms is larger than the number of employees because many are one-woman ventures and many women own more than one firm or multiple firms. To assist them all, the governor created an office to serve as California's single point of contact for economic development and job creation efforts, especially for small businesses. Affectionately, this department is called GoBiz. And last week, the governor proclaimed May to be the Small Business Month in California. California is the nation's leading market for online lending. We are home to headquartered for several most prominent players in the sector: Lending Club, Prosper, SoFi, Affirm, Funding Circle, and others. And the reason I bring up online lending or the fintech sector is because from 2010 to 2014, companies reported online consumer and small business financing activity increased over 900% to $2.3 billion. Now, state regulators currently are getting kind of a bad rap because the industry, the fintech industry, says that a state-by-state regulatory system is too costly, it carries too much of a compliance risk, and it inhibits innovation. State regulators do not totally agree with these criticisms, but I'll tell you, we do acknowledge that the fintech companies have some legitimate concerns about the state system, and we are moving to address them. As the state's main financial regulator, let me tell you what I expect from the fintech sector as it stands today. In many ways, we treat them no different than any other licensee. We expect the same from all of our licensees: compliance, transparency, accountability, sound financial practices, and most important, fair and honest treatment of our consumers. No one should think that they can gouge small business borrowers or any consumers because they operate online. I know the Cfpb agrees that regulators will work hard to keep up with technological innovations, and consumer protections will be as sharp and clear as ever. As the bank regulator or financial services regulator, I am committed to serving the needs of California's small business community and to being a partner to small business stakeholders in California. We welcome your feedback. Call us. Call me. Let me know what you're thinking and what we can do to help. Thank you, and I look forward to a fruitful day.
Thank you, Commissioner Owen, for the generous remarks. Our next speaker is Xavier Becerra. Xavier Becerra is the 33rd Attorney General of the state of California and is the first Latino to hold the office in the history of the state. The state's chief law enforcement officer, Attorney General Becerra, has decades of experience serving the people of California through appointed and elected office, where he has fought for working families, the vitality of Social Security and Medicare programs, and issues to combat poverty among the working poor. He has also championed the state's economy by promoting and addressing issues impacting job-generating industries such as healthcare, clean energy, technology, and entertainment. Attorney General Becerra previously served 12 terms in Congress as a member of the U.S. House of Representatives. While in Congress, Attorney General Becerra was the first Latino to serve as a member of the powerful Committee on Ways and Means. He served as chairman of the House Democratic Caucus and was ranking member of the Ways and Means Subcommittee on Social Security. Prior to serving in Congress, Attorney General Becerra served one term in the California legislature as a representative of the 59th Assembly District in Los Angeles County. He is a former Deputy Attorney General with the California Department of Justice. The Attorney General began his legal career in 1984, working in a legal services office representing the mentally ill. Attorney General Becerra, you have the floor.
I have to make sure I take Sixta everywhere I go because I love the way she pronounces my name. It's Xavier Becerra. I mean, I don't even say it that well. But I know that Director Cordray hired her for way more things than the fact that she can pronounce my name really well. And we're so thrilled that you are here representing us on behalf of the Consumer Financial Protection Bureau here on the West Coast, what we call the avant-garde, the forward-leaning movement of America. I want to say simply a few things. First, I have to cheer the man who is our quarterback when it comes to providing consumers, whether you're a small business person, whether you're an immigrant family trying to navigate your way through this country, or you're a recent graduate from college hoping to just open up your wings. Richard Cordray is our quarterback. And we should do everything we can to make sure he can take the team down the field and score touchdowns all the time for the men and women who want to make America work, who generate the jobs. Because if Richard Cordray succeeds as our director of CFPB, then he's keeping doors open. And that's all we need. You talk to almost any businessman or woman, and all they want to know is there's some predictability behind what they're going to do. Whether it's taxes, regulations, the business climate, if they have a way of knowing the dot on the horizon and how to get there, they'll deal with the rest. It's the uncertainty that causes the real difficulties for especially small businesses. Richard Cordray is a guy who makes sure that that door remains open and that we can all shoot for that point on the horizon. And so we have an obligation to help our quarterback because he has been spectacular, even under some of the most difficult of circumstances. I'm thrilled that Mike Feuer is my, as was said earlier, partner in crime as well. That word is used often, but in this case, it's really true. I love committing crime with Mike Feuer because let me tell you, he knows how to do it well. And we're very fortunate here in Los Angeles to call him our city attorney. He's served us in so many different places, but he does it so well. I feel like whenever I'm with Mike Feuer, I feel like that marathon runner that just came in the top 10, and then here's Mike. He's that Ironman contestant who does the triathlon like nothing and just sort of whizzes on by me as I'm huffing and puffing. It's hard to keep up with Mike, but he's the best. And Commissioner Owen, thank you for what you do, for giving us the perspective we need to know why California is so important, not just to us, but to the nation. You have made it clear why the numbers count, but why the people make the numbers count. And I want to just take a moment to mention the micro, because Commissioner Owen talked about the macro. The micro is this. The micro is you if you have a business, you if you defend small businesses, or people like my parents who started their own business not knowing what they were getting into. My father with a 6th grade education, my mother not coming to this country till she was 18 from Guadalajara, Jalisco, Mexico. But they did. They knew the micro of starting a business. They bought a little house here, and then they rented it out. Then they bought another little house there and rented it out. Before you know it, they were making more in retirement than they ever made when they were working both. And I consider myself a small business person as well because I learned from my parents. And I know this, I don't have time to try to navigate everything that's going around in the business world. You know, it's like Ghostbusters. Who are you going to call? Well, when it comes time to making sure your business is doing okay, Consumer Financial Protection Bureau, Richard Cordray, that's who you call. And we need them to be there for us every step of the way. The Attorney General's office is going to do everything it can to partner with the Consumer Financial Protection Bureau, with our partners at the state level, Ms. Owens, and all the people at the state who try to work on behalf of the people, the 40 million people of the state, and certainly with our city attorneys, our district attorneys who try to protect us every day. But we need your help. And this is where these types of workshops and forums are so important because they get you connected to the people who are ready to help. My job is to enforce the laws for 40 million people in the state of California. We have a very robust consumer protection division in the Attorney General's office. In fact, One of the people who I just recently hired to be my special assistant dealing with the issues involving consumers is Ellie Bloom, who I stole from the Consumer Financial Protection Bureau. Yes, and she's right here as well. And I also have Liz Saldivar, who is here with me also, who is my head of the external affairs, so we can reach out to people and find out what you need us to know so we can act. Under the Constitution of this state, I have the authority to begin independent investigations of any activity where Californians are impacted and harmed. And I intend to use that authority to the hilt on behalf of the people of this country who are like my parents, who worked very hard, were able to establish a business, and now have done so much to make it in the past that college was an unknown to the family, to make it in the past that forever we will only dream of being able to do things for our kids, make it something that's in the past to believe, like my father as a young man could not walk into a restaurant because of the signs that said no dogs or Mexicans allowed. That's all in the past. California is forward-leaning. And one of the reasons we've succeeded in becoming the 6th economic power in the world is because we don't stop. We don't look back. We understand that this is a tough place to do business. Our environment makes it very difficult for businesses to establish here because our air and our water are tough to keep clean. And so we have to impose a lot of different requirements on the gasoline we pump into our cars, on how much we can put into this LA basin before it gets so polluted that your kids can't go out and play or they end up with asthma. 40 million people, that's tough to organize. And so all of that we do, understanding that we're a pretty high cost state, but we're pretty high quality as well. And that requires a lot of effort on the part of all those who are willing to work with quarterback Richard Cordray to make sure that we keep those doors open. That's our job. And so know that you've got the chief law enforcement officer for the city of Los Angeles sitting with you. Know that you've got the person that the governor has appointed to make sure that businesses have that opportunity to have those doors open in Commissioner Owen here with you. And know that the 33rd Attorney General of the state of California is ready to work with them and with you, but most importantly, I'm going to do everything I can to make sure that regardless of what Washington, D.C. does, we don't abandon our quarterback at the Consumer Financial Protection Bureau, because we know what success means when you have Richard Cordray fighting for you. We score lots of touchdowns. In California, we're not going to stop scoring, and we're going to work with Richard Cordray to make sure that everyone in America benefits the way California has by having a forward-leaning policy when it comes to the way we deal with consumer issues and help our people. So thank you, Director Cordray, for being here. I thank all my colleagues, but principally I thank you for knowing that it was important to be here this morning. Have a great day.
Thank you, Attorney General Xavier Becerra. I'm now extremely pleased to introduce Richard Cordray. Prior to his current role as the Consumer Bureau's first director, he led the CFPB's Enforcement Office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect its consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as an Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray.
Thank you. General Becerra referred to football a number of times. My football career peaked in about the 7th grade. But I do remember Vince Lombardi saying that when the going gets tough, the tough get going. It's great to be here with three of our closest and most productive and for me personally, our most dear partners anywhere in the country. And I thank them all for being here today. But most of all, I thank them and their teams for the work they have done, are doing, and will continue to do with us to stand up for Americans who expect and deserve the right kind of support and protections from their government officials, and that's what we mean to do. So thank you for all of that. And thank you all for coming today. It's good to be here again in Los Angeles. Today, the Consumer Financial Protection Bureau is announcing an inquiry into ways to collect and publish information about the financing and credit needs of small businesses, especially those owned by women and minorities. We're well aware of the key role they play in our lives. Small businesses help drive America's economic engine by creating jobs and nurturing local communities. It is estimated they've created 2 out of every 3 jobs since 1993, and that they now provide work, and this jibes with what Jen had to say, for almost half of all employees in the private sector. Yet we perceive large gaps in the public's understanding of how well the financing and credit needs of these entrepreneurs are being served. As you probably know, the Congress provided the Consumer Bureau with certain responsibilities in the area of small business lending, and there's a strong logic behind this. When I served as the Ohio Attorney General, we recognized the need to protect small businesses and nonprofit organizations by accepting and handling complaints on their behalf, just as we did for individual consumers, an approach that proved to be very productive. In addition, the line between consumer finance and small business finance is quite blurred. We heard a lot about that at a roundtable we heard this morning with community and consumer advocates. More than 22 million Americans are small business owners and have no employees. And according to data from the Federal Reserve, almost 2/3 of them rely on their business as their primary source of income. So this is very much embedded in many people's lives. Congress specifically has charged the Consumer Bureau with the responsibility to administer and enforce various laws, including the Equal Credit Opportunity Act. Unlike other consumer financial laws, the Akoa, as it's known, governs not only personal lending, but some commercial lending as well. In fact, we've now conducted a number of Akoa supervisor examinations of small business lending programs at financial institutions. Through that work, we're learning about the challenges financial institutions face in identifying areas where fair lending risk may exist, and we're assisting them in developing the proper tools to manage that risk. In the Dodd-Frank Wall Street Reform and Consumer Protection Act, which created our agency, Congress took a further step to learn more about how to encourage and promote small businesses. To help determine how well the market is functioning and facilitate enforcement of the fair lending laws, Congress directed the Consumer Bureau to develop regulations for financial institutions that lend to small businesses, to collect certain information and report it to the Bureau that we will then share with the public. The request for information we're releasing today asks for public feedback to help us better understand how to carry out this directive in a way that is careful, thoughtful, and cost-effective. We have considerable enthusiasm for this project. In my own case, I've seen firsthand how small business financing can have a big economic impact, and I'll tell you a story about earlier in my life. When I served as the treasurer of Ohio, we had a reduced interest loan program to support job creation and retention by small businesses. The way the program worked was that the state could put money on deposit with banks at a below market rate of interest, and this deposit was then linked to a same-sized loan to a small business at a correspondingly below market rate. This so-called linked deposit program had been authorized more than 20 years earlier, but had gradually fallen into disuse. At its core, however, the program made good sense. Small businesses are often in desperate need of financing to update and expand their operations, often not at large amounts of money. And if they can get inexpensive financing, they can often fertilize their ideas for growth and be even more successful. So we diagnosed this program and found that after its initial success, it had become simply too bureaucratic. We heard from both banks and businesses that the program, which was still paper-based, was so slow and cumbersome that nobody wanted to bother to use it. So we changed all of that. We put the process online, rebranded it as the Grow Now program, and made specific commitments to those who wanted to participate in it. We told them they could fill out a typical application in 30 to 60 minutes, and we promised them they would have a yes or no answer on their application within 72 hours. That was not easy. Some gulps among my staff when I said that, and it required very close coordination with the banks that took part in the program. But we did it, and the Grow Now program really took off. Only about $20 million had been allocated when we started, but in less than 2 years, we deployed more than $350 million, helping about 1,500 small businesses create or retain approximately 15,000 jobs across the state. It was also exciting and interesting to see how the businesses were able to use the loan funds. I can recall a construction business in Northeast Ohio that needed a loan to buy a large piece of equipment so the company could compete for new and different jobs. They got the money, they got the equipment, and they thrived. I recall a manufacturer in Northern Ohio that needed money to turn their factory sideways on their property so they could utilize more space and employ more people. We funded the build-out, they executed on it, and they met their goals for growth of output, revenue, and jobs. And I recall a particular company in Western Ohio that started out as a caterer, began making their own tents for events, recognized they might be able to succeed as tent makers, and needed financing to be able to bid on a major project with the U.S. Defense Department. We got them the loan, they got the bid, and Inc. magazine named them as one of its 500 fastest growing businesses of that year. The moral of this story is that business opportunity, especially opportunities for small businesses, often hinges on the availability of financing. People have immense reserves of energy and imagination. Nowhere is that more true, by the way, than in the state of California. Human ingenuity is the overwhelming power that allows human beings to reinvent the future and make it so. These forces unleash what Joseph Schumpeter called the gales of creative destruction that constantly mold and reshape the patterns of our economic life. Innovation has sharpened our nation's economic edge for generation after generation, but when credit is unavailable, creativity is stifled. To make the kind of meaningful contributions they're capable of making to the American economy, small businesses, particularly women-owned and minority-owned businesses, need access to credit. Without it, they cannot take advantage of opportunities to grow. And with small businesses so deeply woven into the nation's economic fabric, it is essential that the public, along with small business owners themselves, can have a more complete picture of the financing that is available to this key sector. Some things we do know. We're releasing a white paper today that lays out the limited information we currently have about key dimensions of the small business lending landscape. According to census data, and depending on the definition used, there are an estimated 27,600,000 small businesses in the United States. We estimate that together they access about $1.4 trillion, that's trillion, not billion, in credit. Businesses owned by women and minorities play an especially important role in this space. Women-owned businesses account for over 1/3, 36% of all non-farming private sector firms. The 2012 survey of business owners, the most recent such information available, indicates that women-owned firms employed more than 8.4 million people, and minority-owned firms employed more than 7 million people. Those are huge numbers. By comparison, in 2014, fewer than 8 million people were employed in the entire financial services sector. By the way, that was the big paragraph on the facts and figures. I was inspired to get through it by you, Commissioner Owen. When small businesses succeed, they send constant ripples of energy across the economy and throughout our communities. For example, a 2013 study by the Federal Reserve Bank of Atlanta found that counties with higher percentages of their workforce employed by small businesses showed higher local income, higher employment rates, and lower poverty rates. In order to succeed, businesses need access to financing to smooth the cash flows for current operations, meet unexpected contingencies, and invest in their enterprises to take advantage of opportunities as they arise. Another study found that the inability to obtain financing may have prompted 1 in 3 small businesses to trim their workforces and 1 in 5 to cut benefits. Unfortunately, much of the available data on small business lending is too dated or too spotty to paint a full picture of the current state of access to credit for small businesses, especially those owned by women and minorities. For example, we do not know whether certain types of businesses, or those in particular places, may have more or less access to credit. We do not know the extent to which small business lending is shifting from banks to alternative lenders. Nor do we know the extent to which the credit constraints that resulted from the Great Recession persist and to what extent. The Beige Book, produced by the Federal Reserve on a regular basis, is a survey of economic conditions that contains a huge amount of anecdotal information about business activity around the country. But it has no systematic data on how small businesses are faring and whether or how much they're being held back by financing constraints. Given the importance of small businesses to our economy and their critical need to access financing if they're to prosper and grow, it's vitally important to fill in the blanks on how small businesses are able to engage with the credit markets. That is why Congress required financial institutions to report information about their applications for credit from small businesses in accordance with regulations to be issued by the Consumer Bureau. and that is why we're here today for this field hearing. The inquiry we're launching today is a first step toward crafting this mandated rule to collect and report on small business lending data. To prepare for the project, we've been building an outstanding team of experts in small business lending. We're enhancing our knowledge and understanding based on our Equal Credit Opportunity Act compliance work with small business lenders, which is helping us learn more about the credit application process, existing data collection processes, and the nature and extent and management of fair lending risk. We've also learned much from our work on the reporting of home loans under the Home Mortgage Disclosure Act, which has evolved and improved considerably over the past 40 years. At the same time, we recognize that the small business lending market is much different from the mortgage market. It's even more diverse in its range of products and providers, which range from large banks and community banks to marketplace lenders and other emerging players in the fintech space. Community banks play an outsized role in making credit available to small businesses in their local communities. And unlike the mortgage market, many small business lenders have no standard underwriting criteria or widely accepted scoring models. For these reasons and more, we will proceed carefully as we work toward meeting our statutory responsibilities. And we will seek to do so in ways that minimize the burdens on industry. Our request for information released today focuses on several issues. First, we want to determine how best to define small business for these purposes. Despite the great importance of these firms to our economy, there's surprisingly little consensus on what constitutes a small business. For example, the Small Business Administration, in overseeing federal contracting, sometimes looks at the number of employees, sometimes looks at the annual receipts, and applies different thresholds for different industries. For our part, the Consumer Bureau is thinking about how to develop a definition that is consistent with the Small Business Act, but can be tailored to the purposes of collecting business lending data. So we're looking at how the lending industry itself defines small businesses and how that affects the credit application processes. Having this information will help us develop a practical definition that advances our goals and aligns with the common practices of those who lend to small businesses. Second, we want to learn more about where small businesses seek financing and the kinds of loan products that are made available to them. Our initial research tells us that term loans, lines of credit, and credit cards are the all-purpose products used most often by our small businesses. In fact, they make up an estimated 3/4 of the debt in the small business financing market, excluding the financing that merchants or service providers extend to their small business customers to finance purchases of the seller's own goods or services. But we want to find out if other important financing sources are also being tapped by small businesses. Currently, we have limited ability to measure accurately the prevalence of lenders and the products they offer. We also want to learn more about the roles that marketplace lenders, brokers, dealers, and other third parties may play in the application process for these loans. At the same time, we're exploring whether specific types of institutions should be exempted from the requirement to collect and submit data on small business lending. Third, we're seeking comment about the categories of data on small business lending that are currently used, maintained, and reported by financial institutions. In the statute, Congress identified specific pieces of information that should be collected and reported. They include the amount and type of financing applied for, the size and location of the business, the action taken on the application, and the race, ethnicity, and gender of the principal owners. Congress determined that the reporting and disclosure of this information would provide a major boost in understanding small business lending. At the same time, we're sensitive to the fact that various financial institutions may not currently be collecting and reporting all of this information in the context of other regulatory requirements. And we understand that the changes imposed by this rule will create implementation and operational challenges. So we will look into clarifying the precise meaning of some of these required data elements to make sure they're understood and consistently reported. We will be considering whether to add a small number of additional data points to reduce the possibility of misinterpretations or incorrect conclusions when working with more limited information. To this end, we're seeking input on the kinds of data different types of lenders are currently considering in their application processes, as well as any technical challenges posed by collecting and reporting this data. We will put all of this information to work in thinking carefully about how to fashion the regulation mandated by Congress under Section 1071 of the Dodd-Frank Act. Finally, the request for information seeks input on the privacy implications that may arise from disclosure of the information that's reported on small business lending. The law requires the Consumer Bureau to provide the public with information that will enable communities, government entities, and creditors to identify community development needs and opportunities for small businesses, especially those owned by women and minorities. But we're also authorized to limit the data that's made public to advance privacy interests. So we will be exploring options that protect the privacy of applicants and borrowers, as well as the confidentiality interests of financial institutions that are engaged in the lending process. The announcement we're making today and the work we're doing here reflect central tenets of the Consumer Financial Protection Bureau. We are committed to evidence-based decision-making. We aim to develop rules that meet our objectives without creating unintended consequences or undue burdens. We want to see a financial marketplace that offers fairness and opportunity not just to some, but to all. A marketplace that does so without regard to race, ethnicity, gender, or any of the other elements of our fabulous American mosaic. We all know that small businesses are powerful economic engines. They supply jobs that lift people out of poverty or dependence, teach essential skills, and serve as backbones of our communities. So we mean to meet our obligation to develop data that will shed light on their ability to access much-needed financing. It is essential to their future growth and prosperity, and therefore to the growth and prosperity of us all. Because what Cicero observed in ancient Rome still holds true today. He said, "Nothing so cements and holds together all the parts of a society as faith or credit." Our communities depend on both of these precious things just as much today. As we launch this inquiry, I want to remind all of you that we value the feedback we get. We take it seriously, consider it carefully, and integrate it into our thinking and our approach as we figure out how best to go forward with this work. So we ask you to share your thoughts and experiences to help us get there, today and in the future. And we thank you again for joining us here today. Thank you.
Thank you, Director Cordray. At this time, I'd like to invite all the panelists to take the stage. And while they are doing so, I'll briefly introduce them. David Silverman serves as the Bureau's Acting Deputy Director and Associate Director for the Bureau's Research, Markets, and Regulations Division. Cheryl Parker Rose serves as the Assistant Director for the Bureau's Office of Intergovernmental Affairs. Grady Hedgesmith serves as the Assistant Director for the Bureau's Office of Small Business Lending Markets. Our guest panelists include Elba Schildkraut, East Los Angeles Community Development Corporation, Makini Howell, Main Street Alliance member, Josh Silver, National Community Reinvestment Coalition, Kate Larson, U.S. Chamber of Commerce, Todd Hollander, Union Bank, and Robert Villarreal, CDC Small Business Finance. David, you have the floor.
Thank you. I think I can still say good morning, but just barely. As Ix indicated, I'm David Silverman. I'm the Acting Deputy Director of the Bureau and the Associate Director for Research, Markets, and Regulations. It's a pleasure to be here and to chair this portion of our field hearing on small business lending. As you've heard, we're about to hear from a number of respected panelists, consumer advocates, and industry participants from around the nation. Each panel member will give us some background and provide their perspective. We'll then pose questions to our panelists and engage in the discussion, and then the panel discussion will be followed by public testimony where we'll hear from members of the public who have signed up to share their observations. Before we begin our panel discussion, let me take just a moment to frame the issues we're going to be talking about. As Director Cordray noted in his remarks, and as we discussed today in the white paper we have released, small businesses play a key role in fostering community development and fueling economic growth, both nationally and in their local communities. To do so, these businesses, and particularly women-owned and minority-owned businesses, need fair and equal access to credit to allow entrepreneurs to take advantage of the opportunities for growth. As the director also explained, in Section 1071 of the Dodd-Frank Act, Congress amended the Equal Credit Opportunity Act to require financial institutions to compile, maintain, and report certain information concerning credit applications made by small businesses. Congress also directed the Bureau to issue a regulation to govern the data collection and reporting. The purpose of this is twofold. First, to facilitate enforcement of fair lending laws, and second, to enable communities, governmental entities, and creditors to identify business and community development needs and opportunities of women-owned, minority-owned, and small businesses. As Director Cordray explained, we're in the early stages of implementing Section 1071, and we're focused on outreach and research. Today's hearing and the RFI that we issued this morning are important steps in this process as we seek to enhance our understanding of the estimated $1.4 trillion small business financing market so that we can discharge our responsibilities under Section 1071 thoughtfully and pragmatically. So with that as a context, I'm going to invite our panelists to present their opening remarks. Each panelist will have 3 minutes to make a brief statement, and then Grady and Cheryl and I will moderate a discussion with the panelists. So we'll start on my far left with Elba Schildkraut from the East Los Angeles Community Corporation. Elba?
Hi, thank you. I'm very privileged to be here and thinking of my mother on Mexican Mother's Day today. I'm just thinking about her and her being a micro-entrepreneur and just very privileged to be here. She also, we came here from Guadalajara, like Xavier Becerra's family. So at East LA Community Corporation, or ELAC, we advocate for economic and social justice in Boyle Heights and East LA and the greater LA area by building grassroots leadership, developing affordable housing and neighborhood assets, and providing access to economic development opportunities for low and moderate income families. In 2013, we began working with local businesses to preserve the vitality of the small business community in Boyle Heights. Our commercial corridor project is part of our strategic efforts towards responsible community economic development by developing leadership, connecting brick and mortar businesses with technical assistance, and hosting monthly small business meetings. We are empowering our business community to take ownership and be involved in their community. In 2015, we helped form the First Street Community Business Association of Boyle Heights. This small business community is united toward a shared vision of economic stability and inclusivity for all residents of Boyle Heights, including but not limited to brick and mortar businesses and home enterprises, street vendors, and mariachi groups. To help them thrive, small business owners need new resources such as micro-lending and lines of credit. Many of these businesses rely on friends and family's limited resources for loans. They also need case management to ensure that they can make use of resources that already exist, such as technical assistance providers and others doing business support services. It is through this relationship building with small business owners who are primarily Latino, immigrant, monolingual Spanish speakers, and women that we have learned of their needs and challenges in growing their business and obtaining loans from financial institutions. Some of these challenges have been just difficulty in getting credit from banks, especially smaller size loans. Under 250K, some of these small business owners need anywhere from 5 to 10K just to get them started, getting some work done in their kitchen, for example, for the smaller size businesses. They also need there's also a need for data transparency to show which lenders are making loans and to which groups and where these loans are being made. We think that banks should partner and do joint outreach from trusted community groups and address specific needs such as language access. The data should be disaggregated for Latino groups and other groups, such as the HMDA data will start to do in the near future. And small business owners need greater protections, like consumer protections, in order to prevent discrimination. We are excited and supportive of Cfpb's efforts in gathering data from small business lenders and feel that this is important data gathering will be beneficial to the small business community overall. Thank you.
Thank you. Next, McKenna Howell, Main Street Alliance.
Hi, my name is McKinney Howell, and I am a member of the Main Street Alliance of Washington, and we're a coalition of 2,000 small business owners. And I have been running my family's business for 13 years. We've been in business for a total of 40 years. We're food service. I own 6 vegan restaurant concepts in Seattle. I employ over 48 people. I offer health coverage. I start my minimum wage at $15 an hour. And I have grown our family business from grossing $200,000 when I took over 13 years ago to, we closed last year at $3 million. And I didn't do any of this with a bank loan. Now, when I went in to apply for a bank loan, I don't know if it was because I was a woman or if I was black or because I was vegan. Any number of these things are risks for a banker. I understand that, when I talk to consultants, they had no concept of why I wasn't doing a steak. And people ask me, well, aren't you at least going to add fish to your menu? My menu is 100% plant-based. So any number of these things I can understand would be a reach for someone to think would succeed. But not only did we succeed, I toured as Stevie Wonder's personal chef in 2015, but none of these things, absolutely none of this was possible. Not a penny came from traditional lending. And I think that one thing that really has to happen is we have to change our understanding around what can be successful. Because as opposed to framing it as let's collect data and let's let a few well-deserving minorities and women in, people of color and women are the majority of people that are actually providing jobs, and they are the majority of people that are small business owners. And so bankers and banks have to change their framing around who is deserving and who actually can provide jobs for the community, because small businesses are the engine of the economy. And the engine of the economy right now is being run by people of color and by women. And that thinking has to change, and then that lending will then change, along with all of what is happening in Washington. The thing that someone told me, when you walk into a bank, they make a decision right away whether or not they're going to lend to you. Can I dress well enough? Can I be tall enough? Can I be a male? None of those things are going to happen. So the change has to come from understanding who actually helps to run the economy. And so I would still love to get a small business loan. I haven't tried again because I don't necessarily need as much money now because I'm 13 years in. I am probably very attractive now to a lender, but I don't need money now. I needed money then. And so I'm not going to go to a bank and ask for money now when it's not as necessary. But in order to get to where I am, I had to use predatory lending. I had to use cash advances. My dad gave me $10,000. I got one CDFI loan from a community lender. It took me months and months of rewriting my business plan to actually get that. But it's a challenge, and I feel like I would have been a $6 million company if I had gotten the lending necessary at the beginning, and I didn't have to pay the exorbitant fees. And I had the education, I had the support necessary from the banks to help me succeed. So that's my story. Thank you.
Thank you. Josh Silver from the National Community Reinvestment Coalition.
Good morning. I'm Josh Silver, Senior Advisor at the National Community Reinvestment Coalition. I thank the CFPB for this, honored, and I thank the CFPB for this important hearing today. McKinney, there are some lenders on the panel, so maybe they'll be encouraged to give you a loan after this or talk to you. And I think there are very well-intentioned lenders. Last week, USA Today reported on a survey showing improved small business confidence. Looks like things are looking up for small businesses after the Great Recession. Not so fast. The survey was sparse on which small businesses were surveyed. Previous research showed that women, minority-owned, and very small businesses experience difficulties growing because of barriers in accessing credit. Consider the following. Women-owned firms are a significant force, but they remain small. 90% of women-owned small businesses have no employees other than the owner. Part of the difficulty women face is lack of credit. Also, just 5% of women-owned businesses use bank loans to start their businesses compared to 11% of male-owned businesses. Minorities also face difficulties starting and growing their small businesses. Non-minorities are twice as likely as minorities to own employer businesses. If minorities own businesses at the same rate as non-minorities, our country would have 1 million additional employer businesses and more than 9.5 million additional jobs. Surveys have found that African American small businesses are more likely than white-owned businesses to not apply for credit due to fear of rejection. NCRC researchers found that the smallest businesses, those with revenues below $1 million, have the most trouble accessing credit. In 2010, just 8% of these businesses received loans, compared with about 20% of all small businesses. Access to credit is critical for small businesses in regions of the country, yet inequalities in access to credit contribute to overall inequality. NCRC found in a report conducted for the Appalachian Regional Commission that in 2010, the business lending rate in economically distressed counties in Appalachia was just 44% of national rates. The Woodstock Institute found that in Los Angeles, here, and in San Diego, businesses in predominantly minority census tracts were 31% of all businesses, but they received only 21% of the loans under $100,000. A variety of reasons exist for these disparities. Some of it is due to the characteristics of the small businesses, but also some of it is due to discrimination, unfortunately. Here is where an obscure provision, Section 1071 of the Dodd-Frank Wall Street Reform and Consumer Protection Act, will be invaluable. NCRC was honored to have helped members of Congress draft a predecessor to Section 1071 appearing in CRA modernization bills. Section 1071 requires the CFPB to collect data from lending institutions regarding demographic characteristics of small businesses, including race and gender, and to publicly report the data. The mere act of data collection and dissemination is a powerful motivator for lenders to increase responsible lending to underserved businesses. As Director Cordray says, former Supreme Court Justice Louis Brandeis talks about sunlight and the electric light of data disclosure. No lender wants to be highlighted for shirking any part of the community, and they want to get up to speed with the lenders that the data show are doing a better job. Use data for a spur for competition. We have a saying at NCRC that data drives the movement for economic justice. In the small business arena, better data will result in more small businesses, more employment, and more wealth building in underserved communities. Isn't that what we're all about here, making capitalism work in all communities? Thank you.
Thank you. Move to the other side of the table now. Kate Larson from the U.S. Chamber of Commerce.
Good afternoon, everyone. As a proud USC Trojan, I'm very happy to be with you all today in LA. So first, I would like to thank the Bureau for holding this hearing on this very important issue, and especially to Grady and his team for their wonderful outreach over the past couple months. They've been truly fantastic, and we're very excited to engage with them on the request for information. As previously mentioned, I am the director at the U.S. Chamber of Commerce based in Washington, D.C., which is the largest business federation representing the interests of more than 3 million companies of every sector, size, and region. We represent both small businesses and lenders, so we have a unique perspective of seeing the whole picture of small business market and how it affects the end users. In fact, more than 96% of Chamber member companies have fewer than 100 employees. It goes without saying, and we've heard this multiple times this morning, that small businesses are the lifeblood of our economy, not only to produce goods and services that we depend on, but also to create jobs, provide financial stability to millions of Americans. Remarkably, 28 million Main Street institutions account for over half of the sales of the United States, provide 55% of all jobs in the country, and are responsible for 65% of all new job creation. I'm sure you guys can all recite all the stats we've given you this afternoon. Indeed, it's hard to overstate the importance of credit for small businesses that support their inventory, open additional locations, hire more employees, manage seasonal downturns, and otherwise push our economy and our nation forward. This is why we asked the Bureau to conduct a comprehensive, sound report on potential barriers to small business lending in the United States, including regulatory burdens, that it may fully understand the credit products used by small businesses, inform forthcoming rulemaking to ensure it promotes, not inhibits, small business lending, and propose a narrowly tailored rule to include not only necessary businesses and products, while also fulfilling the well-meaning purpose of statute. We hope the SBA will also lend their expertise in this area. Unfortunately, small business lending has not fully recovered from the Great Recession. The most recent small business credit survey that was mentioned earlier, jointly conducted by the Federal Reserve Banks, found that cash flow remains a challenge for small firms. Only half of applicants received financing they applied for, and 18% received none. 32% of firms said they had to delay expansion as a result of the financing shortfall, and 21% had to reach into their personal finances. Clearly, this is not okay. Much of this, and I know that we will all have differing of opinions on the panel, but we think is due to post-crisis regulatory overhaul and increasingly risk-adverse financial institutions that have to meet safety and soundness and know your customer requirements when issuing a loan. So as the Bureau begins its fact-finding process, we hope it will consider the true spirit of the statute and the definition should be tailored to include only the most vulnerable populations. Specifically, the SBA definition of 500 employees doesn't exactly seem like a small business at this juncture. Second, every small business have different needs and approach credit in very different ways. This market is completely different than the mortgage lending, and data collection is not close to the Home Mortgage Disclosure Act, so it's a bit of a misnomer to call it HMDA-like, since there are many different types of credit. Not only are the needs different, but small business lending is a complex market with many sources, as I mentioned. Depending on the needs of the small business, owners may turn to friends and family, home equity lines of credit, credit cards, SBA loans, private small business loans, or a combination of multiple sources. Larger and middle market firms get even more complicated. This is why the definition needs to be narrowly tailored. Employee training will be incredibly complicated given the countless sources of business credit. That could swoop in home equity credit officers issuing a HELOC, flight attendants offering a credit card on a plane, trucking companies offering leasing for certain trucks for business purposes, retail clerks offering branded credit cards. They may not understand that they will also have to capture small business lending data. Also, without a firewall, it will be difficult to create a firewall between the employee accepted the credit application and the one making the underwriting decision. Without a firewall, institutions will be in violation of the Equal Credit Opportunity Act, and that will be even more difficult at smaller institutions. Business representatives applying for a loan, especially if this applies to more than just the owner of the business, may not have the information, which will create confusion and prolong the credit application. They may not know how much they have for annual revenue or the other data points. It is unfeasible for lenders will know if the business changed as the status of a women or minority-owned business, so just to be mindful of that potential hurdle. And it would be impossible for institutions to continuously report individual credit transactions. I didn't tell her I was going to do this, but my wonderful mother, who drove 2.5 hours to be here, is a small business owner. So if she's buying something on a credit card for her business, is that also going to be the same thing as, home goods? So that is a difficult way if you're going credit by credit transaction. So in conclusion, we thank the Bureau for soliciting information, but stress the importance of the Bureau conducting a sound, robust study on the roadblocks inhibiting small business lending, including potential regulatory considerations, to understand where small businesses are obtaining credit and where they are not, ensure the rulemaking will not curtail these valuable sources, and an environment where access to small business credit is constrained, it's imperative we energize the small business market and encourage growth. Our economy and our hardworking citizens depend on it. Again, I appreciate the opportunity to testify and thank the Bureau for its deliberative approach. I look forward to working together, and I'm happy to answer any questions.
Thank you. Todd Hollander from Union Bank.
Hi, I'm Todd Hollander. I'm the head of business banking for Union Bank, and I'm also currently serving as the chairman of the Small Business Committee for the Consumer Bankers Association, and I also serve on the California Bankers Association, so I'm proud to be representing all the groups in this testimony. We wish to express our appreciation for the collaborative and transparent manner in which the CFPB is undertaking the implementation of these proposed rules. In our view, the regulatory environment, private lending, advocacy groups, and lenders share common goals. We want to provide loans to small businesses to help generate jobs, tax revenues, and economic growth and prosperity. Lend to all market segments without bias or discrimination. Enable identification of business and community development needs. Ensure regulators have the ability to hold lenders accountable. And avoid saddling lenders with rules that are unnecessarily costly to implement and execute and that could generate misleading data or curtail access to needed capital. In terms of the current small business lending environment, the CBA sees signs of improvements in the small business lending environment. CBA members say charge-offs and delinquencies for small business loans have greatly decreased from the Great Recession and are currently at all-time lows. SBA lending programs are still vital for many small businesses and marginal borrowers, and the SBA in 2016 had a record year, exhausting the SBA's appropriation of $30 billion. From the peak in 2008, small business lending saw a steady decline until early 2011. Indexed against 2011, small business lending has seen sharp declines. While the trends have improved over the past few years, it is still significantly less than prior to the downturn, as evidenced by utilization rates, historically 40%. I've been doing this for almost 30 years, lending to small businesses. I've worked for large banks and I've worked for community banks. And between the two, you could usually, when you loan to a large population of small businesses, you could set your watch by 40% utilization in that population. Well, after 2008, we saw the utilization rates come down. And what that means is businesses weren't borrowing what they had available to them. And post-recession, we have a much more conservative population of business owners than we had going in, because they felt the pain of firing people, they felt the pain of downsizing and those kinds of things. So not only is the lending environment it's important, but the optimism that businesses feel when they feel confident, they borrow money. When they borrow money, they can feel economic growth, hire people, and do all the things that they need to do. According to the Small Business Financial Exchange and Dun & Bradstreet, small business credit card utilization has also declined every year since 2008 but one, and new accounts openings have been well below the 2007 and 2008 levels. FDIC numbers also report a decline from 2008. In our view, there's a misconception that the whole decline in small business lending volumes is a relate of significantly tightened credit standards. If banks don't lend money, we don't make money. So our job is to deploy capital in the community, and we want to continue to do that. Instead, we noted a decline in demand on such loans. Next hurdle will be the 1071 action. While the CBA and its member organizations support the goals of 1071, we strongly believe that the CFPB should keep top of mind that although the Section 1071 mandates the rule, it is not akin to data collection efforts undertaken on other lending products such as mortgages. As such, the CFPB needs to take great care in the creation of these regulations. We are pleased to see the CFPB pursuing formal information gathering processes to ensure that it is well informed, which will enable it to put forth regulations that optimally accomplish the mandated Dodd-Frank requirements while avoiding costly and burdensome regulations that could lead to higher costs for businesses and less credit available to those businesses. Specific to the challenges, the notion that some hold that business lending parallels nicely to residential mortgage is misplaced. First of all, residential lending has the same collateral type, and business collateral types can vary as widely as the businesses that engage in them. Residential lending has, with rare exceptions, consumers as applicants, and businesses can have all sorts of applicants: limited liability companies, sole proprietorships, 1065 partnerships, 1120 S corps, full corporations. All of these things run the gamut of borrowing and lending. Business loans have a much shorter and varied durations than mortgages, 3 to 5 years typically, as opposed to 15 to 30 years. The appropriate property address to use for reporting and analysis can be debated and has no easy answer. Address of the business versus address of the borrowers. Which address of which borrower should you focus on? And then there's the beneficial ownership question. The applicants to capture for reporting can similarly be debated and has no easy answer. Residential mortgages typically have 1 to 2 consumer borrowers. Small businesses generally have multiple borrowers, large partnerships, officers, directors, guarantors, or a single owner. That also runs the gamut. The CFPB must keenly be aware of these challenges inherent to the nature of small business lending when trying to construct these loans, and it's daunting, and it's twofold. Determining which data fields to collect and constructing fair lending analysis approaches that will yield meaningful and appropriate conclusions from the small business lending community is likely to be even more challenging. In light of these issues and current lending trends, to streamline credit processes in order to extend credit with greater speed to qualified applicants, the CBA and member institutions cannot stress enough the importance of a well-balanced rules under Section 1071 in order to avoid overly burdensome data collection requirements that could stifle small business lending. While the CFPB has broad discretion and authority under 1071, we note that in order to issue fair and achievable rules, that result in meaningful, useful data, the CFPB may need to request from Congress changes to certain aspects of the rule. Examples of well-meaning definitions or requirements are outlined in the rule, but must be made optimal. First, primary address of the business versus whether the business serves a minority or the address of the borrowers regardless of where they locate. 2, the definition of minority and women necessitates the determination of both ownership and earnings allocation. Third, access to this data, including incidental access, unlike the mortgage space, is strictly prohibited for underwriters, and in the event that they do have access to it, mandates disclosure to applicants. This is unnecessary and impractical. Thank you for the opportunity and to testify, and thank you for the comment period. We look forward to continuing to work collaboratively with you for a successful outcome. Thank you.
Thank you. And finally, and without Zix to help me with the pronunciation, Robert Villarreal. Yeah, that's what I said.
Great job, I'm sure. Thank you, Acting Deputy Director Silverman, Director Cordray, and Assistant Directors Parker, Rose, and Hedges-Smith. We appreciate you coming out to Southern California and Los Angeles. It's important that you're here. In the city of Los Angeles, 50% of the businesses, according to the 2012 census, are minority-owned. In the county, 55%. And that's 5 years old, so we know those numbers already have changed and they shifted, so it's a greater amount. I'm with CDC Small Business Finance. We're headquartered in San Diego. That's that city that gave you a football team that you didn't want. And I'm also the executive vice president there, but I'm also the president and CEO of Banker Small Business CDC of California. That's an affiliated CDFI, part of the CDC small business family. CDC Small Business Finance is a 39-year-old company. We are a certified development company. That means we provide the SBA 504 product. That's a commercial real estate lending product. We partner with banks such as Union Bank, where they do 50%. We, as an agent of the SBA, do 40%, and the small business only has to put 10% down. We also are a SBA Community Advantage lender. That is a program that allowed mission-based lenders, such as ourselves, to do S7A loans up to $250,000. The gentleman a few seats down to my left created that program when he was with the SBA, and it's had a wonderful impact on particularly the small business and minority communities. I believe SBA lenders do less than 4% of their loans to African Americans across the country. Community Advantage lenders do about 13% of their loans to Latinos and African Americans. So it's been a great program. So we are the largest organization that does both of those, the SBA 504 and the SBA 7A Community Advantage, and we work in the states of California, Arizona, and Nevada. But we really are an economic development organization. So while we've done about $13 billion in lending, most of that has been through the commercial real estate. About $2 billion has gone to women, minority, and veterans. And through our non-504 program, so that's our 7A lending community advantage, we're a micro lender, and through our CDFIs. At one point, believe it or not, we had 3 different CDFIs in Southern California. Now we just have the one. We've done about $70 million in lending, particularly in Southern California. So I'm sitting here to the right of the banker, but my take will be a little bit different than that industry, in that I think it's very important that we're here, and I think it's important that the folks in the audience are here, and I'm looking forward to hearing from everybody later in regards to why we're here and why 1071 is important. And let me give you at least 3 reasons why I think it's important, and why, as State Attorney Becerra said, that we need our quarterback. We need to be supportive of them. Racial discriminations still exist. There was a study done by Utah State, BYU, and Rutgers University, published in the Washington Post in June of 2014. They took 9 individuals, 3 African Americans, 3 Latinos, and 3 Anglos, gave them the exact same resume and history, dressed them exactly the same, and they walked into banks. There was clear differentiation in the way the people of color were treated. So it still exists in the lending world. More recently, I think Josh also quoted the Woodstock Institute Patterns of Disparity that was done in January, released in January of this year. What Josh talked about was they looked at Chicago, LA, and San Diego, and they lumped in Los Angeles and San Diego, and he talked about the lack of lending in those census tracts. And in fact, if there had been lending to the amount of small businesses in those census tracts that were census tracts predominantly of color, that was a $1.6 billion opportunity that was lost for those census tracts for communities of color. So it's very important. But why 1071 is real critical is all we have right now is we can look at CRA, but we have to look at census tracts. We don't know who is getting, or what individuals are getting the loans. So let's look at the city of Los Angeles or the county of Los Angeles. In 2015, there was $4.7 billion, about $280,000 loans under $250,000. This is CRA reportable in the FFEIC website. Same year, SBA, there was about 1,750 loans for about 136 million. So in terms of units, the SBA was less than 0.5% of the total. I'm looking at Michael Banner because I think I always told him it was 4%, and it was 0.5% in units, and in dollars, it was a little less than 3%. So that means there was 99% of the loans that went out in the county of Los Angeles. We don't know who they, under $250,000, we don't know who they went to, right? We can look at the census tracts where they went to, and we can say, well, they're predominantly minority, and there's probably minority small businesses there, but we can't find out who they went to. And more importantly, with 1071, we'll find out who applied and what happened to those individuals when they didn't get the loan, or if they didn't get the loan. So I implore the folks here, my colleagues here and the CFPB, that this is important. And yeah, it's going to take a lot of work, and we'll have to hammer out and come to some agreements. But it's, at the end of the day, it's very important that we take this mandated rule and that we implement it. So we look forward to working with everybody here and to get that done.
Thank you. Thanks to all the panelists for your thoughtful remarks. So Grady, my colleague Grady Hedgepeth, the Assistant Director for Small Business Lending, and Cheryl Parker Rose, the Assistant Director for Intergovernmental Affairs, and I are now going to ask the panelists some questions to try and generate some further discussion. I get the first question, Robert, to you. Talk a little bit about the challenges that financial institutions face when extending commercial credit to small businesses, particularly minority and women-owned businesses.
Yeah. So I'll try to be brief because there's lenders out here and there's lots of reasons. But I will base it on my 12 years of experience working at CDC Small Business Finance. I had conversations with my colleagues about this. And also, CDC Small Business Finance just had a report done on Latino small businesses in the state of California. And it was done for us by the National Association for Latino Community Asset Builders, NALCAB, based out of San Antonio, Texas. And hopefully we'll make that public at the end of this month or early June. So while all small businesses face very similar challenges, entrepreneurs that are women or that are people of color have particular challenges. So a couple of them. One is record keeping or financial documentation, or really it's the lack thereof. And there could be a variety of reasons for that. Maybe some of them are cash-based businesses, but really it comes down to financial literacy. Now, when I say that, I'm not saying that small businesses, particularly businesses of color, are financially illiterate. No, far from that. What the challenge is that lenders, whether you're a union bank or whether you're CDC Small Business Finance, have certain criteria and documentation that we require, and we put people through some horrendous hoops to get an SBA loan, and a lot of folks just don't have that background. And I use, since mothers were used and fathers were used, I'll use my father from Tepic Nayarit, which isn't far from Guadalajara, a little further south, who came over with a 6th grade education and ran 2 very successful businesses, a restaurant and a parking lot. He never received a loan from a bank, and he never could have put together the documentation that I know my company asked for somebody. So he wasn't financially literate. He just didn't understand the way the system worked here. So as lenders, it's working with small businesses, and how do you work around that? How do you educate them? and yet have the patience to get them through the process. So as a mission-based lender, as a nonprofit, we put money into paying business advisors to help individuals with that. So that's one. A second one is also what's known as a thin credit file or, poor credit. Experian did a study that was released in September of last year that showed that businesses, minority-owned businesses, their business score was 5 points lower than a non-minority, and that their personal credit score was about 15 points lower. A lot of lenders, really, one of the first questions they'll ask is, what's your credit score? Because there's a threshold, and if you're not at 680, and if that's you're at that institution, if that's your threshold, and you're at 679, a lot of them are going to ask you, to walk out the door, or they're not going to finance you as they put you into their credit scoring model. So that is the challenge as lenders: is how do we work with those that have a poor credit that probably doesn't completely dictate their ability to pay, and how do we look at other factors? And then I think the third and fourth for me are really combined, and that is, because I've learned from individuals like this guy, and we've seen it, is it takes just about as much money to underwrite and process a $50,000 loan than a $500,000 loan. So if you're a profit-driven organization, who are you going to lend to? So again, as a mission-based lender, we're going to work with those that want $5,000 or $10,000. But how do we build efficiencies with that? And how do we deal with fintech, the financial technology, and those competitors of ours that are charging 94%? We have refinanced loans at 94%. How do we deal with that when they can give somebody an answer in a couple of minutes and finance them within a couple of days? So that's very difficult. So that's a challenge, I think, for reputable lenders who are trying to do right and trying to do good and treat people with a lot of respect.
Thank you. Cheryl?
Thank you. Josh, what are some of the current barriers to understanding the small business lending landscape?
Well, thank you, Cheryl. Short answer, current barriers, lack of data. Longer answer is that 1071 will mandate, I'm sorry, bad to swallow when you're trying to talk. Give me 1 second, don't take my time off. So, type of lender, large bank, small bank, credit union, non-bank, fintech. I think we need data on all these lenders because we need to know which ones are making responsible loans that are sustainable and borrowers can repay, and which ones need a little more oversight. The literature talks about smaller banks being relationship lenders and really getting to know the small business owner and having more flexibility in their underwriting. That the bigger banks tend to use automated underwriting, and some of the studies suggest that the smaller banks have an easier time reaching underserved populations. The problem is we haven't had the data for the smaller banks for a number of years. Actually, in the mid-2000s, the bank regulators actually exempted the smaller banks from some Community Reinvestment Act data reporting requirements. So we need that data back to better understand the market and to really know who is making responsible loans to traditionally underserved businesses. I should also say that NCRC did a study for the Appalachian Regional Commission that showed that the smaller banks were about 20% of the market in several states. So it's very important to understand what they're doing, for example. Loan type, this is huge. Whether the loan is an origination, whether it's a refinance, whether it's a renewal, whether it's a line of credit, because different credit needs are served by these different types of loans. And actually, I talked about the Community Reinvestment Act data, which large banks over $1 billion in assets report. This is probably the most systematic data that we have now, but there are significant limitations. And one limitation is the reporting rules are a bit strange, that there's actually renewals being reported with originations. I think it's mostly originations, but there are some renewals in there as well, and you can't separate them out. That clouds our understanding. Credit card lending, for example, is higher cost lending. It is needed, but term loans that are lower cost lending is also needed. And we there's basically, at this point, there's a crude way to differentiate credit card lending from term lending in the CRA data, but we need better data because there has been some SBA studies that have shown that minorities disproportionately rely upon credit card lending. And if we had better data, again, we could use a spur of competition to encourage more term lending by traditional banks. And also factoring, which is a form of high-cost lending. Actually, the white paper, the CFPB, when you look at the number of transactions, not the dollar amounts, but you look at the number of transactions, it actually looked like factoring was higher than term lending. So we need more data on high-cost types of lending to make sure that it's not the new subprime lending that is actually stripping wealth instead of responsibly serving credit needs. Loan action, Robert talked about it. We need data on applications as well as denials. The CRA data only has data on originations to really know whether it is unmet demand or in some communities, is there low demand, and what could be ways to increase the demand in some communities. Revenue size of small business, this is huge. Actually, most of small businesses have sales of less than $100,000, as shown in the CFPB white paper. But the CRA data, the existing data, only tells you whether it's above, whether the loan is made to a small business above or below $1 million in revenue. And I could go on. We need data on reasons for denial. Is it insufficient collateral? Is it credit history? Is it inadequate documentation? Is the business too new? Some of these factors have been mentioned before. We have some of this data in HMDA data. Look, I'm not asking for the sky. I'm asking for some very well-defined. There are some statutory requirements like race and gender of the small business owner. The CFPB has some data, has some discretion to add some data elements. We do this carefully, but if we do it carefully and we do it well, we can understand whether controlling for a lot of these characteristics, whether there are still disparities that need further investigation. And through robust data collection, hopefully we can make American capitalism work better in all communities. Isn't that what we're all about? Shouldn't there be a bipartisan consensus for this, that the better data, more transparency makes markets work better, increases small business lending, and then ultimately people who are working hard and playing by the rules can provide for themselves and their communities. This should be beyond question.
Grady. Todd, CBA, consumer bankers are always very thoughtful. Your remarks are very thoughtful. And you've already mentioned some of these, but what are the unique aspects to consider when you extend credit for commercial purposes, commercial credit to a small business? What's unique about that?
There are a few things that are unique when you extend credit to any small businesses. First is the complicated ownership structures and how you assess each ownership structure and determine ability to repay. Next is the difficulty in separating the ability and the willingness to repay. So as we mentioned, especially for smaller businesses, the interrelated nature of their personal credit and their business credit make it hard to separate. So you need to consider how they've repaid their debt up to the start of their business or after their business as part of the picture. Next is varied collateral. Lots of lending that we do is unsecured. We don't even put a UCC filing on the company. Some is partially secured, which is a UCC filing, which is the minimal. And then we take direct collateral for things as equipment and real estate and things like that, so varied collateral. The next thing is the multiple purposes for the loans. We lend for anything from working capital to fixed assets, permanent working capital, acquisitions, versus consumer lending that's relatively straightforward. As I mentioned before, the closely interrelated nature between the personal and business finances of closely held companies are hard to separate. And the last couple things are relative age and depth of balance sheets of small businesses tend to be less deep and with less reliable data than large businesses. So it becomes an art, and then the quality of the information is less. And as Roberto mentioned earlier, the cost to which we need to process these things economically and still make money for the bank and protect our depositors make it difficult, but not impossible to do.
Mahaney, can you talk about do small businesses owners have access to credit to grow their businesses?
Me?
Yeah.
My name is McKinney.
McKinney, I'm sorry.
Like zucchini.
It's vegan. Right?
It's vegan. I'm sorry, could you repeat the question?
Sure. Do small business owners have access to credit to grow their businesses?
In my experience, I did not have access to a traditional bank loan to grow my business. I had access to credit. I had access to a fintech loan. I had access to merchant cash advances, which is predatory, basically predatory lending, where you purchase funds. So if you need a $30,000 loan, you could purchase it for $15,000 and end up paying back $45,000. I think that one of the questions was, how do reputable lenders combat that? I think reputable lenders have to relook at their bottom line and what they need to make off of a $50,000 loan and a $500,000 loan. I think that when we raised the minimum wage to 15 in Seattle, all business owners had to have a different understanding of their profit margin. And I think if you really want to help, because the predatory lenders have gotten a hold of the market, you have to rethink your profit margin as a legitimate lender, because there's always available capital, but it could bankrupt you if you take that. And if you have to pay it back in 2 or 3 months sometimes, and that's generous. So some of the problems around it are, you get junk fees, which are like $700. They can be up to $800 tacked on to a $1,000 weekly payment, or they'll take out the payments daily. You can get on some of my notes, borrowers paid an average of 94% of an APR according to the Opportunity Fund. And as it is, 44% of small businesses rely on expensive credit cards or financing. Stalled growth. If you've taken a cash advance and you hit a slow season and you're not making money and your fixed assets have not, and your fixed costs have not changed, your rent, your payroll hasn't changed, that could tank your business, because you still have to pay back this exorbitant loan that you've taken out, and it's not really even considered a loan, it's considered purchasing funds. You have to pay that back in addition to all of your fixed expenses. So yes, to answer your question, there's money available, but it's not necessarily the money that will help you to grow your business. More than likely, it's money that will help to bankrupt your business.
Thank you. Cheryl?
Thank you. My question is for Kate. Kate, what should small businesses be aware of in terms of accessing credit from financial institutions?
Thank you, Cheryl. So I'm going to mimic a lot of what Robert said earlier. Documentation, documentation, documentation. So first, know your business plan inside and out. Understand that institutions, it's not that they just don't want to give you credit, it's that they do have very stringent safety and soundness and know your customer requirements that are from the regulators. Obviously, we don't want to relive the Great Recession. A lot of that was ability to repay. So post-crisis, regulators are even more strict about the ability to repay requirements. So that is why we are concerned about maintaining access to credit while, of course, giving it out in a safe and sound manner. But to small businesses, I would say to come as prepared as possible with any type of financials that you have, any type of projections, in order to give institutions kind of the cover in a way to explain to their regulators, we know this person is going to be able to pay this loan back because of X, Y, and Z. They can't just say, they seemed like a really nice person, they've got a great idea. It's not gonna work like that. So I would say any type of documentation that you have available, and just really understanding your business plan and what credit would be right for you. So whether it's marketplace lending, traditional bank credit, SBA loans, and I think that that would be possibly a good avenue for the Bureau, and I'd be happy to work collaboratively to identify those types of different credit, because I think that a lot of people don't know what is available. So that also is a financial literacy piece.
Grady?
Alba, this question is to you. What type of credit is available to small business owners who cannot access loans from traditional lenders?
Yeah, so very similar to what McKinney mentioned is the predatory loans that are out there, including merchant cash advances. They're very similar to payday lendings. Some of the some of the small business owners use personal credit and credit cards, so they get into really high interest credit cards in order to be able to use that. There's also just loans from their family members or friends. Some of the things that we've worked at along with members of the California Reinvestment Coalition and CLR and NALCAB, even members of NALCAB as well, we're all members of all those organizations, is looking at how we expand and help the business owner with technical assistance, with helping them with their credit score. So a lot of times is that there's no distinction between personal finance, personal credit score, and a business score. So it's really important, and a lot of people are talking about financial literacy. Is more their financial education and just knowing their options and understanding their credit score and what credit score is about and how they can utilize that. So a lot of the CDFIs that are out there, they can make loans, but they can't make them as much as we would like to. A lot of them need more funding, and there needs to be more education about what's out there and their options. With us at East LA Community Corporation, ELAC, we have a social lending loan we call lending circles. So for those of you that have heard of tandas or condinas in Spanish, it's a social loan where people lend to each other. And what we have done is, in partnership with the Bay Area another nonprofit organization, Mission Asset Fund, we've been able to do very small loans so that they can improve their credit. So there's no interest, there's no fees, and they're basically lending to each other, and this is being reported to all three of the credit bureaus. So we're starting with even some of the micro entrepreneurs like street vendors, and even to small business owners that have brick and mortar, so that they can start working towards their credit. And all of this comes with financial education, financial coaching, and technical assistance to help them get to the documentation that we're talking about, right? And a lot of our people that we work with, our small business owners, are immigrants, and they are monolingual Spanish speakers, and they trust our organizations like us, and we have already earned their trust in the community, so they're able to come to us so we can speak to them in regards to the different options and different loans that are out there.
Thank you. So I have one last question, which we'll ask all panelists. We'll give all panelists a chance to offer any closing remarks. We are running a little behind, so I'll ask you to try and keep your answers briefly. But the question is, what could be the benefits and challenges to conduct small business lending data and to collecting small business lending data and making it available to the public? And let's go in the opposite order from which we started. So Robert, we'll start with you and go around.
Just a couple. So I think it's a good way to distinguish who the good and the bad players are, and we can see who's doing the loans and who's not, and who's potentially discriminating against people of color. But I really see it as more than anything as an opportunity. It's going to be an opportunity not only for the traditional financial institutions. When they see the data, they're going to see opportunities in new markets. As I mentioned, Los Angeles County, 55% of the small businesses are minority owned. So really, we don't approach this as it is a challenge, but don't take it completely as a challenge, but really as an opportunity to really see where you could grow your market in the next phase of your financial institution.
Todd?
Okay. Well, there are definitely benefits to this and challenges, as I'm sure you've gathered from all our statements. So we already do a lot of data collection. So whatever we do with the 1071 action, I'd caution us to make sure that we don't double up on the work adding to the costs. We need to establish a minimum set of data standards that take into account that there's not, we did a survey amongst the 60 banks that belong to the Consumer Bankers Association. I'd be surprised if 2 matched on how the banks define a small business or a small business loan. It can take on all kinds of product, loan amount, loan type, entity type, and things. So I'd caution you to take all those things into consideration. Also, the risk of inaccurate or drawing in wrong conclusions from the data that's extracted remains high. And I think that if we're not careful in the way that we disseminate the information, the way that we interpret the information, and it's not completely objective, we could run the risk of increasing legal costs and leading to incorrect conclusions with the output of the data and how it can be manipulated. So in conclusion, I think that it's necessary. I think banks want to put capital in the hands of the people who will use it. The better our business community does, the better the banks do, and we're just a reflection of the community that we represent. So we look forward, as Kate said, to working with you to establish the right rules. And again, thank you for the collaborative nature you're engaging in this.
Kate.
All right, I'll be brief. So I already stated the challenges that we've been looking at, so I won't bore you with them again. Just want to say, as Josh said earlier, this is a common goal. I totally agree with Director Cordray's statement in his opening that when credit is unavailable, creativity suffers. That is very true. So we're all working together to ensure that there is credit for the small businesses that need it. With that said, I would like to underscore that we hope to minimize the regulatory hurdles and decrease the cost of underwriting. So after Dodd-Frank, the cost of underwriting for any commercial loan has escalated to about $7,000 per loan. So as Robert indicated, that's, for a $100,000 loan, that's for $1 million loan. So we just want to make sure that the hurdles that institutions have to go through are minimized in order to get credit to the people who will repay and, so we can grow small businesses. In terms of the privacy aspect, there are definitely concerns about the publication. In the day of data breaches, clearly governmental agencies are not immune to them. So that is always a concern. And then re-identification in terms of the different loans. And there could also be an anti-competitive nature if the loans are re-identified. But again, mimic what Tom said, very excited to work with you going forward.
Thank you. Josh. Hi. So my grandfathers were grocery store owners and started shortly after the Great Depression. And I wonder how they did it. I wonder if they got loans. And if we had more information way back when, I think we would have more. We'd have more economic. Would have helped the Great Depression. And now we are in the years after the Great Recession. And I want to caution a couple of statements that were made that overregulation has stifled or retarded lending. In the years before the financial crisis, it was the reverse. It was a lack of regulation. The Federal Reserve Board had on the books in 1994, they had the ability to curb abusive lending, and they didn't do anything. And we all know about lending beyond people's ability to repay. And we know that not only caused a recession in this country, but a global recession. And in fact, small business lending has not, I think, it's been underregulated. We don't have the same consumer protections. So yes, it is a balancing act, but it's a balancing act, but if anything, there's not enough regulation and oversight in the small business lending arena. More data will not stifle lending. It will not delay loan processing. We've had 40 years of experience with the Home Mortgage Disclosure Act data. It is a regular part of business. And yes, there are costs, but I think even for financial institutions, the benefits outweigh the costs because they want to know how competitive they're doing. When the new HMDA data becomes available in March and you can request it from individual lenders, it's not consumer groups that are the biggest askers for the data. It's actually banks asking other banks for their data, for other banks' data, so they can see how well they're competing in all markets. So data actually, if it's done well and you have good information on loan terms and conditions, it actually makes the lending marketplace more competitive. And I think also if you do it carefully, you won't get wrong conclusions. You won't get unnecessary litigation. We've had 40 years of HMDA experience. There have been instances, Department of Justice and Cfpb, where there has been egregious behavior, and the data helped us stop the behavior before it did continue damage. And we won't know what the extent of the egregious behavior if there isn't data, and if there is more data, there will be a lot less harmful. There'll be a lot less harmful behavior. And then lastly than not least, we've had a lot of CRA small business data reporting. We can build on an experience to make this I think we've lost $14 trillion in a Great Recession because of abusive lending. If we have better transparency in the marketplace, we can gain trillions of dollars in wealth in our communities. Small businesses get more loans. Thank you.
I'll get it right this time. McKinney, like zucchini.
Yes. So I think that it is a great opportunity to not only collect data on whether it's a black woman, an Asian man applying for a loan, but it's an opportunity to create an understanding that education comes before literacy and to change the culture of lending in banks. So if we work on the culture of lending and understanding the engine that the people of color and the women create for small businesses and understand how much money is sitting there, sometimes lost on the table, and we understand that it's not an unwillingness to pay back, but there hasn't the literacy, the education has to come before the literacy piece, and then that way you can lend safely to a community, understanding that they understand how to pay that money back.
Finally, Elva.
Yeah, thank you. So yeah, we think that the benefits are going to outweigh the challenges. Honestly, there's going to be a better understanding of the market, similar to the HMDA data, to help local government decide how to allocate resources to help identify discrimination. This data is very important. There's going to be better lending and even more lending, I believe, once we know where this lending is happening. The evaluation of products are they reaching the communities in need and with the right loan products. So that is very important that we don't know right now, and even inform policy and make assessments and address issues. Thank you.
Thank you. So this concludes the panel portion of our programs, and please join me in thanking all of our panelists for a thoughtful discussion. So let me invite the panelists to take their seats and turn the program back over to Zixta Martinez, our Associate Director for External Affairs, who's going to moderate the next portion of the field hearing. You stay.
Thank you, David, and once again, thank you to our distinguished panel of experts. That was a terrific conversation. I now turn to one of my favorite parts of our field hearing, which is hearing from you all. An important part of how the Bureau helps consumer finance markets work is to hear directly from consumers, from industry, from our state and local partners, from community advocates across the U.S. One of the ways that the Bureau gathers public feedback is through events such as these. We have held field hearings, town halls, and other events across the U.S., from Miami, Florida, to Itta, Mississippi, to Seattle, Washington. At these events, we not only hear from experts, we also invite the public to participate. But before I open the floor up to public comments, I want to remind folks that there are several other ways to communicate your observations, your concerns, or your complaints to the CFPB. You can submit a consumer complaint with the CFPB through our website at consumerfinance.gov. Our website will walk you through that process. The CFPB takes complaints about mortgages, car loans or leases, payday loans, student loans, or other consumer loans. We also take complaints about credit cards, prepaid cards, credit reporting, debt collections, money transfers, bank accounts and services, and other financial services. If you don't have a specific complaint but want to share your story with us, we have a feature on our website called Tell Your Story, where you can tell us your story, good or bad, about your experience with consumer financial products or services. Your story will help inform the work that we do to protect consumers and create a fairer marketplace. We also have another feature called Ask CFPB, where you can find answers to over 1,000 frequently asked questions about consumer financial issues, as well as additional resources. We have a Spanish language website called CFPB en Español, which provides access to essential consumer resources, as well as answers to consumers' frequently asked questions. I encourage you to visit consumerfinance.gov so you can learn more about the resources and tools that the Bureau has developed to help consumers make the best decisions for themselves and for their family. Now it's time to hear from members of the public that are here today. A number of you have signed up to provide comments and observations about today's discussion. The public comment portion of the field hearing is an important opportunity for the Consumer Bureau to learn and hear about what's happening in consumer finance markets in your community. Each person that signed up to provide testimony will have 2 minutes to do so, and what we hear is invaluable. We want to hear from as many of you as signed up as possible, so I encourage you to please stick to the 2-minute limit so that everyone who signed up to provide comment has the opportunity to do so. Our first commenters are members of the federal and state community that we work with, and so I would invite Arthur Zeno with the Federal Reserve Bank of San Francisco to provide remarks. Our staff will bring a microphone to you. Okay. Melody Winterhead.
Okay. All right. Hi, everyone. I'm with the Community Development Group here in Southern California with the Federal Reserve Bank of San Francisco. And the subject of data collection with small business lending is something that between the local reserve banks and the Board of Governors in Washington is a very important concern. And we have extensive data on this subject, and in particular, we have data around small business ownership and the connection to auto loan financing. And of great concern to us is what is happening with discrimination in that market with lenders of all sizes, large and small and independent auto lease agents or lenders. And so we're here today really to listen to what is happening here, what the Cfpb is leading, and then to provide support and advice as we do in our responsibility with 1071. Thank you.
Thank you, Ms. Winterhead. We appreciate the outreach, and we look forward to engaging in substantive conversation and collaborative efforts with you. Ron Fong.
Thank you. Good afternoon. My comments are focused on the need to continue to improve the collection of more detailed data for Asian Americans, Native Hawaiians, and Pacific Islander communities. As the nation continues to diversify and the population approaches majority and minority status in 2044, accurate and standardized data collection and reporting of race and ethnicity is critical to ensuring that federal departments and agencies understand the needs of diverse communities and are able to effectively meet their obligations to serve the American people. Data collection and reporting is particularly salient for Asian Americans, Native Hawaiian, and Pacific Islanders, who comprise over 20 million people, trace their heritage to more than 50 countries, and speak over 100 different languages. We recommend that federal agencies adopt the recommendations of the Census Bureau 2015 National Content Test for proposed additional minimum race and ethnicity categories. Got all of that out there. We recommend that these categories be applied in 3 areas where small business data is being collected. That includes the Home Mortgage Disclosure Act, small business lending reported under the Community Reinvestment Act, and U.S. Small Business Administration loans. We believe that the data that results from this action will result in a better assessment of our community's needs, better targeting of solutions from both the public and private sector, greater access to financial services and capital for our community's small businesses, and ultimately healthier Asian American and Native Hawaiian Pacific Islander communities. Thank you.
Thank you, Mr. Fong. Joey Quinto.
Hi, I'm Joey Quinto, publisher of California Journal for Filipino Americans, and I'm representing the Green Lining Institute. Green Lining Institute is a multi-ethnic policy and advocacy organization working to bring the American dream within the reach of communities of color. We would like to raise 3 issues pertaining to minority business enterprises in California today. Number 1, underwriters must take into account non-traditional payment sources, and cash flow. Underwriters need to take into account untraditional payment sources and restructure decisions. Many small businesses are financially responsible and have the ability to pay back loans, but their cash flows don't allow them to pay at the right time. For example, a coalition member have worked with a law firm that focuses on minority clients in civil disputes. The firm receives payment from settlements that they are not necessarily paid out on a monthly basis. Underwriters need to take the business cash flow into account. Number two, marketplace lenders and fintech companies are preying on the minority business enterprises. Community lenders and CDFIs are seeing a surge of MBEs with loans they cannot afford from companies such as Cabbage and LoanMe. They are charging interest rates between 30 to 105% annual percentage rate. The fintech companies provide a way of getting money fast, but have direct access to business accounts and exorbitant fees. And
Thank you,
fines
Mr. Quinto. Please submit your statement for the record, and we'll make sure it's part of the field hearing record.
Sure.
Thank you.
Okay.
Kevin Stein?
She'll hold it, okay. Hi, my name is Kevin Stein. I'm with the California Reinvestment Coalition. We're a coalition of 300 nonprofits throughout California, many of whom work with small business in various ways. We primarily want to thank the CFPB for all the work that you do, for coming to Los Angeles, to hearing about the needs of small businesses, and for protecting our communities. You can play such an important role in this particular arena. The data that we have on small business lending is inadequate. The few observations we can make about what's happening based on the data and the experience of our members: number one, there's less access to credit in low-income neighborhoods and neighborhoods of color. Number two, banks are not doing a good job with regard to small business lending, in particular, loans of smaller loan sizes into smaller businesses, so that much of what we consider small business lending is actually going to businesses with over $1 million in revenue. Number three, that non-bank higher cost lenders are filling this void, and as we heard before, small businesses enjoy fewer protections than consumers. Highly problematic. Perhaps one of the more problematic products is the merchant cash advance product that has been mentioned. Seems virtually unregulated. Perhaps Commissioner Owen and others can help us address that issue. And fourth, CDFIs and community lenders do not have the capacity and the capital to meet the community need. In conclusion, we recommend and urge CFPB to do three things. Continue on with this first step. We're very pleased to see you come forward in this public way in moving forward the 1071 data. We're very hopeful that the data can be to small business lending what HMDA has been for home lending. How can all the people who say they support small businesses have problems with helping in this way or even presenting challenges? So we're concerned when we hear about challenges. To continue the work with regard to Akoa. So we're glad to hear the director point out that the Bureau is working with lenders to ensure that there are not fair lending violations. That's terrific. And to the extent that there are violations, we hope that there's aggressive enforcement.
Thank
and then
you, Mr.
lastly,
Stein.
if I may, to expand the consumer complaint database, which we think is a wonderful tool, but to make it clear and more user-friendly for small businesses so they can identify concerns about fair lending, Akoa violations, and also inform the data you might collect under 1071. Thank you so much.
Thank you. Lori June. Scott Pearson. Sharon Lindemann.
Good afternoon. My name is Sharon Lindemann. I'm here today representing the interest of credit unions in California and Nevada. First, I want to thank the Bureau for this field hearing and reaching out to the various stakeholders, including the Department of Business Oversight Commissioner Jan Owen. The Bureau, my comments today are focused on 2 points. One is the Bureau should be careful in drafting the definition of not only the small businesses, but also small business loans, so as not to discourage lending. And any new data collection requirements for women-owned, minority-owned, and small businesses should be limited to the data elements required by Section 1071 of the Dodd-Frank Act. Since the Great Recession, credit unions have actually seen a growth in small business lending. Many consumers turn to the local credit union for their small business loan needs after they've experienced difficulty obtaining loans from other larger institutions. Credit unions provide needed capital to existing small businesses as well as to startups. There are statutory limits on the aggregate amount of member business loans that may be held by federally insured credit unions. The National Credit Union Administration's definition of a member business loan excludes business loans to a member when the net business loan balances are equal to or less than $50,000. The Bureau, as consumer advocates, should encourage these small dollar business purpose loans also by exempting them from any member business lending regulations or reporting. The leagues urge the Bureau to narrowly define a small business loan and not create a conflicting definition that result in an administrative nightmare for credit unions. Section 1071 of the Dodd-Frank Act amends the Equal Credit Opportunity Act to require financial institutions to report certain information concerning the credit applications. The leagues are concerned that the Bureau will use its discretion to require additional data beyond what is required in the Act, as they did with HMDA, the rule. The Dodd-Frank Act required 17 new data points for HMDA reporting. However, the CFPB expanded that and added additional 16 additional data points.
Thank you,
The
Ms.
expanded
Lindemann.
data, if I may, just one more. The expanded data collection created an additional burden on credit unions as well as the industry. Thank you for the opportunity to comment.
Thank you. Namak Sakom.
Thank you for this opportunity. My name is Namoj Sokom. I'm the director for Pace Finance Corporations. I would like to support the statements of Ron Fong's, where the desegregations of data collected. An example would be in the API community. It looks like we are doing very well in terms of getting the loan overall, but the subset Southeast Asian community are still at the bottom of getting these loans that are intended for the minority. So desegregations and recommended that the 2015 census data point would be adopted into the new data collections. Thank you.
Thank you. Chris Walters. Arlene Williams. Victor Ramirez. Flossie Hall.
Hi, I'm Flossie Hall. I'm actually a small business owner in San Diego, and I just wanted to address the issues of small lending and basically the difference between personal lines of credit and business lines of credit. When you start a business, mostly everything goes on to your personal credit. As for what Kate said, credit cards, loans, mortgaging your house, things of that nature. And at what point do banks step in and say, you've had enough time in business, you have enough revenues, you have enough profitability, you've met these margins, but your credit score personally has suffered because of the damage you've done to build your business, and they still won't even let you in the door to say, yes, you can have money. It's an immediate no because it's a quick click of a button on a computer that checks your credit score.
Thank you, Ms. Hall. Andy Koblitz.
Hi, I'm Andy Koblenz from the National Automobile Dealers Association. We appreciate the opportunity to be here. Director Cordray's remarks highlighted the potential benefits to small, women-owned, and minority-owned businesses of a rule implementing Section 1071, and we thank him for that. But these remarks only mentioned in passing the considerable and unprecedented compliance burdens that could be imposed by such a rule especially on creditors who are small businesses themselves. While the RFI indicates that you are looking for information in this area, it's essential that you fully and accurately account for this burden and ensure that it can be managed by small business creditors. And in this regard, we would be interested in knowing what coordination has been had thus far with the Federal Reserve Board, which, rather than the CFPB, will be implementing Section 1071 for a very large cohort of those small business creditors, auto and truck dealers engaged in indirect auto lending. Thank you.
Thank you. Osefa Alofetu.
Thank you. Yes, my name is Yosefa Olofaituli, and on behalf of Opportunity Fund and all of our clients, we want to thank CFPB for this platform. Opportunity Fund, for those of you who are not familiar, is a CDFI. We're the largest nonprofit microlender in California, and we've deployed over $164 million over our 24-year history. Last year, we did $65 million of microloans, 2,200 originated. But to Opportunity Fund, the development and implementation of Section 1071 serves to illuminate two purposes. One, obviously, access to capital, and the other, protection from predatory practices. I wanted to highlight a business right down the street from here along Cesar Chavez called Clever Dog. The owner, David Oshima, opened up this shared space here in Chinatown with the intention of creating a space for folks to grow their own businesses. And as we know, over the last few years, these co-working spaces have expanded. And as part of David's success in wanting to finance remodeling and expansion of his building, he wasn't able to access a loan through his local bank, even after 4 years of success and stellar credit, because the line of credit that he needed was $15,000 and not very large. He essentially got a no and was referred to us by the bank, and we provided that loan for his construction and expansion. And now he's going on his 6th year of success. But David's story is just one illustration of how low dollar amounts have few bank opportunities for a lot of our small bank community. I want to highlight 3 points before I get cut off, and that is around the data collection. First, it's critical that CFPB collect data around clients' race, gender, and geographic location to understand both where and to whom discrimination may be occurring. Second, the CFPB should collect data on both mainstream products like term loans, but also merchant cash advances and other types of credit card credit extensions. Finally, Opportunity Fund recommends that data be collected on financing interest rates, fees, and terms, as well as performance. Default rates or repayment rates is important to understand the effectiveness of these products. So thanks to the panel, and thanks to Director Cordray for this platform.
Thank you for your comments. Yvette Nunez.
Hi, I'm Yvette Nunez. I'm the Director for Economic Development at CD Tech. We're a nonprofit in South LA, and we have engaged small businesses from manufacturers to neighborhood mom and pop shops for 20 years. We have heard their concerns on access to capital. Their loan size needs and revenue profile don't fit traditional bank guidelines, so they're often declined. And we're even talking about businesses that have been 40 years in business. We also hear about their being approached by predator lenders offering quick money at high interest rates. For these small businesses, it's tempting to say yes. But fortunately, we have been able to educate and refer them to alternative lenders whose interest is in helping their business and not taking advantage of them. But still, there are so many businesses who are being trapped in the predator lending debt. Small businesses need greater protections. We need to require all lenders to provide transparent lending data. We need caps on interest rates and loan terms, and we need fair lending to women and borrowers of color. Small businesses are the economic engine for our communities, like South LA, our region, and our nation, so we hope you'll do all you can to help them stay in business. Thank you.
Thank you. Kevin Savada. Marcia Charles.
Hello, how are you? My name is Marcia Charles. I'm the owner and the operator of a boutique called Pinky Rose. and I'm a designer as well, manufacturer. I've been in business for 13 years, and I'm definitely can relate to Makini here and the other lady that just stood here. Opportunity Fund was able to help me after being one of those who did get a loan from Cabbage, one of those. You can get it in no time. It was a 45% interest loan, almost after being in business for so many years, took me down because I needed that money after 2008 collapse. I truly thank you for everything that you're doing. I'm going to keep it short, and I thank Opportunity Fund for helping. We need the help. We definitely need the help. And for 13 years, if I've been in business in 13 years, I can pay back. I can pay back. I have no problem paying back. If I paid $900 a month to Cabbage, I can pay back a loan. Okay? Thank you.
Thank you. Miguel Acuna. Sharon Evabs. Jaime Legassi. James Kurtz. Michael Banner. Randy Groyan. Richard Pillay Jr. Natalie Pampas. Stephen Michael.
Thanks very much. My name is Stephen Michael. I'm with the Main Street Alliance. We are a network of tens of thousands of small business owners all across the country. We've got chapters currently in 15 states, one here in California. We definitely appreciate the opportunity to speak, and thank you so much for highlighting one of our members, Makini Howell, on the panel, and for the opportunity earlier this morning in the community roundtable with Flossie Hall as well. These were just two stories from thousands and thousands of our members all across the country that struggle with these same issues of access to capital, and I think and fair capital. One of the challenges that we keep hearing time and time again is the necessity to relate this financial education and business education and that support with the capital access with fair lending rates that small business owners really need. Main Street Alliance definitely supports the CFPB's efforts to address some of the challenges that small business owners, especially business owners of color and women business owners, often these are the most enterprising, hardworking individuals in our communities, but they are given the least fair shot. Not only are these business owners not able to obtain the capital they need from traditional sources, but with the decrease in lending to these business owners, we've seen, as we've heard, a spike in the predatory lenders that target our constituents. Because of these issues, Main Street Alliance strongly recommends increased transparent data collection to show which lenders are making and not making which loans to different communities, as well as greater protections for small business owners against the unfair lending practices now prevalent in the lending space. We'll submit longer comments for the public testimony as well. Thanks.
Thank you for the comments, and I want to invite all the public commenters today to submit further comments in the event they didn't get to share everything they wanted to during their time here. I also want to thank the audience, our expert panelists, and to everyone watching via live stream at consumerfinance.gov. This concludes the CFPB's field hearing in Los Angeles, California. Have a great afternoon.